Hi, welcome to Numeric's video blog, your expert source on derivative trends and topics. I'm your host, Jim Jockel. Joining me today via Frankfurt is Udi Seller, our resident FX expert. Udi, welcome.
Thank you. Good morning to you, Jim.
Udi, so we just closed out a volatile Q3, and there were some great summary points on Bloomberg that I just want to read. So almost 11 trillion has been wiped out of the value of the global stock markets. Oil has posted its worst quarter since 2009. China's Shanghai Composite Index was the worst performing benchmark globally, falling 29%. Asian currencies suffered multi-year record losses, and gold continues to suffer, posting its fifth successive quarterly loss and its worst performance since 1997. So, Udi, let's start. What in the world will Q4 hold for us?
Well, basically, there were a couple of drivers that brought this very volatile quarter. In the end of the day, you mentioned things like China. Well, the market has been up 150%, so a correction of 20-30% is not that scary. Now, the main driver was, of course, the Federal Reserve and fears of rate hiking, which did not materialize in September. So obviously, the main thing that will drive is whether the Fed will hike rates in either October or December, right? Looking now at the perception of the market, it seems that in October there's about 5% chance, this is the market estimate, for a rate hike. And in December we're looking at something like 30% of chances or likelihood. So having also looked at the recent unemployment numbers and non-farm payroll that were out this Friday, the numbers were disappointing. So again, it doesn't seem that the Fed will be really determined on hiking. Now we can say that it could be perceived if they do not hike rates, so maybe the market, will continue to progress. And this is actually what happened. On Friday, at the beginning, when the numbers came out, all the global exchanges went down because the economy is in a poor state. And then when people figured, okay, the Fed will not hike rates, maybe that was the reason perhaps for the correction. So I personally think it will grind higher, to answer your question.
So just thinking about the rate hike, clearly there's still concerns about inflation out there. This lack of hike is taking an arrow out of the quiver, if you will, in terms of correction. Do you think we'll see this hike at the end of this year?
I personally hope we do. Just a symbolic hike, again, 20 or 30 basis points, just to show. I think the economies need to move towards a normal state again, and this cheap funding basically has created many bubbles. And what we've seen during Q3 is actually a lot of air going out to the bubble, which is not such a bad thing in the end of the day. So yeah, I think that the Fed will want to mark a step towards the normalization of the economy, and yes, so I think they will hike slightly and slowly.
Moving across, obviously, with oil having its worst quarter, commodities is dominating headlines, especially around the news around Glencore. What do you think we're going to start seeing, now that Russia's getting involved in terms of oil and as well for the broader commodities market over the next 3 months?
I think that, first of all, the supersonic hike in commodities over the last 5-7 years really came from China. China consuming raw materials, energy, and so forth. And now we know that the Chinese economy is going down. So there will be less demand from China. And it really depends on the type of the commodity. But I think that we are finding more or less a floor, at least for energy, those levels. I think that, shale oil from the U.S. at these price levels is not economic. So because I think the break-even level is something like $60 a barrel, and now we're like hovering at $46. So I think in the end of the day, the supply and demand will balance themselves. And when we mentioned Glencore, right? So this is we we saw these wild swings, etc., in the prices, and basically now Glencore is, in a way, is a cheap option to buy a call option on commodity prices, if you like. And I think this is what drove the move the last 2 days.
So one final question for you, Udi. Let's talk a little bit about correlation, right? You know, obviously we're seeing tremendous volatility in the markets, and driven by macroeconomic events, which is driven by commodities. You know, from the investor perspective, what is the thought process about correlation, and how are people managing the way the markets are becoming very highly correlated again?
This is really a fantastic question, Jim, and because the market is, since even as you know, as expressed in the subprime crisis, we saw that everything was correlated between credit spreads to FX rates, yield curves, equity prices, and so forth. So what we do see is the emergence of the volatility as an asset class as a fantastic way to diversify and to hedge. And indeed, if you look at the activity on the VIX and the volatility of the volatility, that just shows you that how people now use it. They use volatility to hedge, and they use volatility to invest. And this is what I think this is the best way to go forward. We may even see people actually start punting on correlation, starting taking a view on correlation. This is actually something we're looking into right now.
And Udi, any closing thoughts? What's going to keep you up at night over the next couple of weeks, or you know, what's on your personal watch list?
I think something we haven't discussed in the past is to look at the five-year inflation expectations, because they keep declining, and basically the problem of now of almost all economies that we don't have enough demand. There's not enough pricing power for the firms. And we basically things we know we produce more than we consume. So I think this is really, you know, inflation expectations. I think this is something that the Fed will be looking at. At least the Fed is looking at, we all should look at it.
Well, Udi, I want to thank you so much for taking your time from your hotel room in Frankfurt today. And of course, we want to stay in touch with you as the quarter continues to unfold and check in with you again. And of course, on the Numerics video blog, it's our goal to examine the topics that you want to talk about. So please keep the conversation going on LinkedIn or on Twitter at NX Analytics. Thank you, Udi, and thank you so much for joining.